Welcome. My name is Rich Cagle, and I'm with Cypress Business Brokers. We're located in Houston, Texas, and serve Southeast Texas. We help entrepreneurs realize the value in their businesses. This is part three in a series devoted to taking the mystery out of business valuation. In previous episodes, we covered some of the basic concepts of business valuation and the three basic approaches to business valuation analysis. In this episode, we're going to look at how we estimate the value of a future stream of cash flows. This presentation contains general information about the valuation process. However, it is not intended to give you advice about your own particular situation. You should always consult with your own advisors and should engage a qualified professional to assist in any valuation assessment. Common sense tells us that cash to be received sometime in the future is worth less than cash in your hand today. Why? It's all about risk. There's the risk you will never realize the expected future cash flow. Remember Wimpy? I'll gladly pay you on Tuesday for a hamburger today. Unfortunately, he never specified which Tuesday he was referring to. Anyone who has ever had a variable rate loan has experienced interest rate risk. As we'll see in a minute, bond investors accept interest rate risk when they buy a bond. The value of their investment will fluctuate with market interest rates. Opportunity cost is a way of saying that we have alternative uses for our cash. We could invest it in another opportunity, in this one, sit on it, or spend it. Discounting is the mathematical technique we use to measure and account for risk. Let's look at an example. A treasury bond is a classic example of a financial instrument with zero credit risk. Whether or not that's still true is beyond the scope of our discussion today, but let's assume that it is. Let's say we could buy a bond today for $10,000 that will mature in 1 year and repay our investment plus 5% interest. How much will we receive? The interest is simply our investment amount, $10,000, times the interest rate, 5%, which equals $500. So we'll receive $10,500 in 1 year. Looking at it the other way, the right to receive $10,500 in 1 year is worth $10,000 today. Before we go any further, let's define a few terms. Future value is the amount we expect to receive sometime in the future. In our previous treasury bond example, it was the $10,500 to be received in a year. Present value is the amount we'll invest today to receive the future value. And again, in our previous example, it's the $10,000 that we spend to buy the bond. And the discount rate is the implicit interest rate that we use to calculate the present value. So in other words, $10,000 invested today at 5% has a future value of $10,500 in 1 year. Conversely, $10,500 to be received in a year, applying a discount rate of 5%, we would say it is worth $10,000 today. On to the math. Finance, like physics, is really a field of applied mathematics. I'll try to keep the math as simple as possible, certainly no more complicated than high school algebra. As we saw in our previous bond example earlier, the future value is the present value plus interest earned over the period of investment. The amount of interest earned is equal to the interest rate times the principal amount of the investment. So we substitute PV times R for I in the first equation. We get future value is equal to present value plus present value times the interest rate. So simplifying, we get future value is equal to present value times 1 plus the interest rate. So from our previous example, investing $10,000 at 5% for 1 year, we get $10,000 times 1.05 equals $10,500. Suppose we invested $10,000 earning 5% for 2 years. Here's where things get interesting and we start to see the effects of compounding. Previously, we determined the value at the end of year 1 was $10,500. In year 2, we'll not only earn interest on our $10,000, but also on the $500 interest earned in year 1. So our value at the end of year 2 is $10,500 times 1.05 equals 11,025. Mathematically, the value at the end of year 2 is the value of year 1, present value times 1 plus the interest rate, times 1 plus the interest rate. Simplifying, we get future value is equal to present value times 1 plus the interest rate to the nth power, where n is the number of periods of compounding. For example, if this were 3 years, n would be 3. We can divide both sides of the equation by the 1 plus r to the nth power to solve for present value. In this case, present value is equal to future value divided by 1 plus the interest rate raised to the power of the number of periods of compounding. Let's test our present value model. Using our treasury bond example, we expect to receive $11,025 in 2 years. Market interest rate is 5%. That is what we would expect to receive on a different investment with the same risk over the same term. So let's go through the calculations. From our equation, present value is equal to the future value divided by 1 plus r to the n, where in this case, the future value is the $11,025, r is 5%, and n is 2. So that says present value is $11,025 divided by 1.05 times 1.05. Stated differently, present value is $11,025 divided by 1.1025. Present value is therefore $10,000, which is exactly what our original investment was. Putting our bond investor hat on, let's suppose we're looking at a bond that will pay $11,025 in 2 years. In today's market, similar investments are earning 6%. How much is this bond worth? We go through the same present value calculation as before. Using a 6% discount rate, you can see we take the future value, $11,025, divided by 1.06 to the second power, which is 1.1236, and arrive at a present value of $9,812.21. This says we could invest $9,812 for 2 years at 6%, and we'll have $11,025 at the end, the same as the bond. Remember when we mentioned interest rate risk earlier? This is an example of interest rate risk. If we'd originally paid $10,000 for this bond and wanted to sell it now, it's only worth $9,812. The difference, $188, is due to interest rate fluctuations. This chart illustrates interest rate risk on a $10,000 investment in a bond paying a 6% coupon rate, 5 years to maturity. Under those assumptions, we calculate a future value of $13,382. Looking at the discount rate, the discount rate represents the market interest rate. And as that discount rate is lower than the 6% coupon rate on the bond, the value of the bond goes up. Conversely, if that discount rate goes up, if market interest rates are higher than the 6%, then a bondholder would pay less for this bond during the coupon rate of that bond. The price of the bond goes down. The choice of a discount rate is similar to the analysis we went through in the last episode to select an earnings multiple. It involves assessing operating risk, that is, how much uncertainty surrounds earnings forecasts. It also involves macroeconomic forecasts of future interest rates and comparing with expected returns associated with alternative uses of investment funds. To briefly review assessing operational risk, there are a number of factors to consider here. Let's take a look at a few of them. Revenues. Obviously, revenues or sales are important, as revenues are the source of profits. Levels of revenue is important, but we should also consider trends in revenue. Is it growing year over year, stagnant, or declining? How much does this company's revenue levels compare with other similar companies? How likely is it that future revenues can be estimated based upon past revenue levels? If a company relies on a few major customers, it is much riskier than a company that has large, diverse customer base. The loss of even one major customer could change a profitable company into a loser. Repeat business, or business coming from referrals of past customers, is an indicator of customer satisfaction with the company and its products or services. Looking at accounts receivable collection history can give us perspective on the quality of customers. High bad debt write-offs indicate a high-risk customer base. After all, a sale is only a sale when cash is received. When someone buys or invests in a business, what they really are buying is the future stream of cash flows or profits. We should look at profit margins, return on sales, and return on investment to evaluate the business performance and compare it with its peers. What are the trends in profits? A consistent trend of increasing profits would justify a lower discount rate than a level or declining profit trend. Understanding the competitive environment is critical to assessing the risk to the company's profit trend. How likely is it that a new competitor will enter the market? Are there any barriers to entry that would make it more difficult for a new competitor? Is there something unique about the business being evaluated? How does the company position its products or services? Is it a premium product or a discount brand? Yet another factor to consider when picking a discount rate is how reliant the business is on its owner. Does the company have written procedures and processes, or are they carried around in the owner's head? Are customers and suppliers loyal to their relationship with the owner or to the company's products and services? Is there a management team in place to operate the business in the owner's absence? Could a buyer expect that the owner will be cooperative during the transition? In a sale, is the owner willing to partially finance the deal? Remember in our last episode, we briefly talked about the discounted cash flow method. Using this method, first we project future earnings, typically over 5 years, but it could be longer or shorter. We estimate a selling price for the business at the end of the projection timeline. Then we determine an appropriate discount rate. And the discount rate represents a risk-adjusted opportunity cost of capital for a prospective buyer or investor. And we calculate the present value of the projected cash flow stream. So let's apply what we now know about present value and valuing future cash flows and take a look at an example. We've prepared a 5-year projection of earnings for our example company. In the first year, we expect $10,000, and we expect earnings to grow by 6% per year thereafter. Based upon the forecasted year 5 earnings, we expect to sell the company at the end of year 5 for $34,719. The total cash received column is simply the yearly earnings added to the proceeds of the sale. We've chosen a discount rate of 35%. As we discussed in our previous episode, investment in a small business is significantly more risky than investing in the stock market, the bond market, or real estate. Investors expect a much higher rate of return to compensate for that risk. 35% is based on our best estimate for risks associated with the projected future cash flows. We then divide each year's cash receipt by the discount rate to get the present value of that year's cash flows. In year 2, for example, the discount rate is 1.35 times 1.35. Then we sum up all of the present values since they reflect the value of each year's cash flow today. Under these assumptions, we would value this company at $31,934. Some final thoughts. We've all heard the saying, a bird in the hand is worth 2 in the bush. Another way of saying that is cash today is worth more than cash tomorrow. Discounting is a way to estimate the current value of a future event. Using the discounted cash flow method to value a business, we forecast future cash flows, we determine an appropriate risk-adjusted discount rate, and then we calculate the present value of the projected cash flows. It's highly dependent on the credibility of those forecasts. Thank you for your time today. I hope this has been informative. In this episode, we looked at the discounted cash flow model. In future episodes, we'll talk about financial statement analysis, and then we'll put it all together with evaluation and analysis of an example company. If I can offer any assistance, please feel free to contact me. Visit us on the web or on Facebook. I'd love to hear your comments and any suggested topics for the next program. If you'd like to be informed when the next presentation is available, please send me your email address. I promise to respect your privacy and I'll never share your information with anyone.